Hey everyone, welcome to another edition of the Buddy Study Group for Worksite Solutions, and it is time for another product roundup. We're constantly seeing changes with group carriers, group products. New products are coming in, more are on the horizon. There is just constantly a lot to update you about. So, product roundups are something we generally try to do at least twice a year. Last one was in April, so good time to bring it back around today. So we're going to go through, the industry leading or most kind of prominent carriers in this space right now. We're going to go through their product specs. We'll go through their eligibility. We'll go through pricing. And along the way, we'll give you what we have from our resources to help you get a better understanding of that. So, Mark, do you want to just give people a general kind of thought that you have on the market? I know we're
Mhm.
still in the first inning of a nine-inning ball game as far as group long-term care goes, and we've seen some changes, but there are a lot more to come. Just how are you feeling about the market right now?
I'm feeling really strong. I mean, we kind of talked about this even as 2 years ago, 3 years ago, that we saw this trend of more carriers entering and definitely continuing to see that. New product releases every couple of months. We're not seeing carriers exit the market or take their products off the market. They're actually adding a second product now. We're hearing now about a third product from some carriers, all with LTC focus on them. So that's always good news, right? The carriers, like the risk that they're seeing, they're getting premium volume. I think for maybe two or three of the carriers in this space, this is their largest worksite benefit product now, is the long-term care with life or life with long-term care, depending on how you position it. So yeah, I would say as a broad stroke, we're seeing that trend continuing. One of the other things that I've noticed is certain product designs are becoming more popular. So I think that term with LTC, which we saw probably originally from Chubb combined, which they probably developed 15 plus years ago. Now I've seen six different carriers with that product, believe it or not. So it's either a term to 121 or a term to 100. But the idea being is let's build a low cost term product with long-term care extension riders so your long-term care doesn't expire and your premiums stay level for life, which obviously kind of solves the rate increase concerns. Um, Continuing to see a lot of groups that had traditional products moving to the group side. So seeing a lot of quotes from, okay, this group had a Unum or a CNA or a Genworth, and they haven't had the same rates for their newer employees. Those rates have gone up. In some cases, the enforced rates have gone up quite a bit too. Can we get something, for at least the new hires that's more robust? So I think that's going to continue to see growth just because there's quite a lot of outstanding groups that are looking for that refresh. So, Jason, I don't know if any specific areas, but those are three big, I'll call it high level trends that I'm seeing.
Yeah, I think that helps. And before we kind of go into a bit of the meat of the comparison, speaking of traditional long-term care, we see a lot of groups that had it that are looking to quote kind of the predominant life long-term care hybrid plans that are out there on the market right now for a number of reasons, but we're also hearing rumblings about traditional long-term
Hmm.
care re-entering the group space. We don't see a lot
Hmm.
of really new business plans at all for traditional long-term care right now that aren't, really tied to an individual solution team underwriting process. But what are your thoughts there? If traditional long-term care is to come back to the group market, what do you think we'll see, and what do you want to see? Or you can answer that even in reverse. What do you want, and what do you think we'll see?
Well, I'll do the think first.
Okay.
There are at least two carriers that are going to launch a traditional group product or worksite product in 2026. So we know that for a fact. I think the two carriers, just based on what I've seen from them, they're going to come in somewhat conservatively. They've been in
Yeah.
the traditional market before. You know, they're going to use all that data to price their product more conservatively. I think what they're going to find is that they're up against some very, very competitive hybrids. And we stack up the pricing side by side, which, we like to do with our quick quote calculators, it's going to become very clear, do these products compete well or not, and what niches do they solve for? So
Right.
that's what I think. Now, you would ask what I want, which is hopefully going to get to those carriers to make the changes that we need to see, is definitely they need to leverage the tax deductibility of traditional. That's
100%.
going to be the big advantage. The 10 pays, prepaying the premium, big advantage. Partnership protection, big advantages. So there are a lot of these sweet spots, um, but they're going to have to come in with like really leaning into those advantages. And right now they're not. They're kind of trying to do what the hybrids are doing, but not doing it as well. I think that's where they're going to fall short. So that's my prediction. That's what I'm advising them personally to do. That might not be where the broader market is at. Everyone wants to go after these large groups on a voluntary basis, but you really have to be able to compete, and be realistic about what you're targeting, I think, to have success. And hopefully they're able to pivot because every new product that comes in the market, you never get it right in the first try. You don't get it all perfect, and you just have to be able to quickly pivot to where you're finding the traction.
Yeah, I think I agree with you there on you need to kind of lean into your differentiators if you're going to be bringing a traditional product into this market. I am super excited for that competition if the carriers are kind of willing to lean into the tax deductibility because selfishly for everyone, including myself, I want these hybrid carriers to pay attention and, find competitive scenarios where the tax deductibility is actually challenging them in a
Mm.
side-by-side comparison so that we can say, hey, you can do that to a limited extent too with separately identifiable long-term care premiums, right? So I
Right.
think that competition is really good because it's going to push the incumbents to add enhancements to their product that are not only good for the clients, the business owners, but they're good for us as people who have known that story for quite a long time and know that is a huge advantage to bring into a sale. Now, should it be the cornerstone of the sale? No, I think it should be something that kind of pushes the case over the edge. I think the group needs to have an interest or a heart for long-term care, or at least offering more robust benefits to their employees. But that's something I'm really looking forward to myself. So what I'm gonna do is last time we made a handy dandy little chart. I don't know if you were on for this one, Mark, when we did this. I made a handy dandy little chart where I just kind of, row by row, compared the carriers by a few pieces of information. Okay. Now, some of these pieces of info are general based on our enrollment experience. Your experience based on the group you are working with may vary in a lot of these cases. So, for many, for your specific group, treat this as a guideline, but you won't know until you go through the process and see what the carrier comes back and says. So we do have a couple of carriers with two products, like Mark said. Um, we have Trustmark's Universal Life Events and their Life Plus Care product. They're termed to age 121. And we have Allstate with their Guaranteed Whole Life product and their term to 100 product. Okay. Chubb, it has that lifetime benefit term that many of us are familiar with, the term to age 121, um, going to be very similar in structure in chassis to Life Plus Care, relatively similar to Allstate, but we're a term to age 100 there. And then Transamerica with their universal life called UL10. In most states, New York, Vermont, Virginia, we're going to be dealing with a product called Trans Elite with a very similar structure, just some differences when it comes to the long-term care benefit and what we actually have available from a plan design standpoint. So one of the things that I did here was really give you an idea of who is eligible from an age perspective for this plan and who is eligible from an age range perspective for the long-term care benefit. Okay, so in many cases, the long-term care benefit has a lower age cutoff than the general life product availability. So there are scenarios where older employees can purchase a life benefit, but they won't have long-term care benefit because they have essentially aged out of the long-term care rider. So when we look at long-term care availability, we have Chubb really kind of leading the pack here. Folks up to 80 can get access to their long-term care rider. However, that long-term care benefit is generally capped at about 50,000, so it's a smaller amount and there's simplified issue underwriting that is involved with being able to purchase that benefit. So your acceptance is not guaranteed, but it's really nice to see kind of an upper age range offer like this. I don't know how many 80-year-old employees we will run into in many cases, but if you're doing some sort of non-employer and who knows, people like to work, you know, um, right up into the later stages of life, this could be a sweet spot that helps you.
Yeah, and I'll
Uh,
also say one more thing about those 65 to 80-year-old products. Even when they have LTC, they are going to be significantly more expensive.
yes,
Um, Almost like a final expense product is what you'll end up seeing just because the underwriting concessions make it, obviously very risky for them to
correct.
be too much
And that
benefit there.
steep slope starts at age 60, really, is what we've kind of seen as like the major break point you could eyeball as this is starting to get, multiplicatively expensive in some cases. Um, for Allstate, the standard, we're looking at 18 to 70 for the age range for the long-term care rider. Trustmark is a little different, 18 to 64 for ULE, and 18 to 75 for their Life Plus Care product. Now, the one note about Life Plus Care and this age range, yes, it is expanded, but generally in my experience, guaranteed issue, extension of benefits, and restoration of the death benefit are only available to a max of age 70. So you're going to have a pretty stripped down long-term care benefit once you get above age 70, but still nice to see that they're kind of raising the ceiling on that benefit. Transamerica is 18 to 65 for the long-term care rider, but they also have a chronic care rider which I should include here. So I will. 18 to 75 for chronic care rider. The chronic care rider has a lot of the similar language of the long-term care rider, but it is not, say, a 7702B long-term care rider. Okay, so for maybe like future state payroll tax considerations, you're gonna want to look at the long-term care rider, but the chronic care rider does have that kind of expanded uh, eligibility there. Then when we get to group size, a lot of this, we'll be able to see in use of our product buddy tool, but for group size, generally the minimum for Chubb is 100 plus. For groups of 50 plus that are very special, make Chubb very happy to see with full employer funding. You may be able to squeak a case of 50 plus through with Chubb, but I think for a rule of thumb, you should just consider Chubb as a 100 plus life option. And generally, Trustmark and Chubb are going to want to see groups generally much larger than 100. I think employer funding to kind of help push the case over the edge is definitely going to help if you have a group that's, say, in the low hundreds. Generally, these carriers are going to want to work with groups that are 1,000 plus, but 100 plus is kind of the minimum we see for both carriers. Now, Allstate and Transamerica are our two small group carriers here, so guaranteed issue down to 3 lives for Allstate with a condition, 5 plus lives for Transamerica for guaranteed issue. So both of these carriers willing to accommodate small groups. With Allstate to go down to 3, we actually have a 6 app minimum. So what does that mean if I have a group of 5 lives or, anywhere from 3 to 5 lives? We have to add another voluntary benefit product to the enrollment. And between the long-term care and that other voluntary benefit, we have to reach 6 applications. So that means a couple of things. Number one, you're going to want to think about what other product can we add to the long-term care offering? Is it a low-cost accident plan? Is it a low-cost critical illness plan? Something of that nature with good long-term care overlap, or, in general, just being consultative with the group to find out, what of their voluntary benefits package over at Allstate could fill in that gap. And number two, employer funding, though never technically mandatory, is quite customary for groups of this size. If we have 6 employees or 3 employees or 5 employees and we have a 6 app minimum, we can't just bank on 100% voluntary participation. Employer funding is really needed to make sure that we hit that app minimum so that we have a case that we know for sure is going to get us a GI offer. And same for Transamerica, right? If we are down to, 5 lives, even 10, 15 lives, and we want to make sure we hit that 5 application minimum, we're going to want some sort of employer funding, even if it's just to that app minimum, a small base policy for 5 employees. We want to make sure we're able to trigger GI enrollment for those. So employer funding type, I wouldn't read too far into this, but I just kind of put like what we most popularly see. List bill employer funding for Chubb and generally for Trustmark and for Allstate, we generally see a salary gross up or a reimbursement kind of bonus plan where the employee will actually apply and pay for the plan themselves, and the employer will generally gross up their salary or reimburse them for the premium that they paid for the plan up to a certain amount or up to a certain benefit level. Um, and then Transamerica, we see a lot of list bill employer funding as well. Mark, is there anything you want to add to that piece? I know there's some flexibility case to case, but any thoughts on that?
No, I mean that is definitely the landscape. I would say that we are seeing some trends in the future that will change this a little bit.
Yes.
So you'll see, salary gross up for Trustmark. We've heard recently they're starting to pilot a list bill for that situation. Allstate kind of depends on whether you can do
Yes.
a list bill on the group size. I'm not sure if you mentioned that. And then the LTC acceleration, that's another trend we see where products are coming in with higher acceleration percentages. So expect to see some of the newer products that are coming out are going to kind of lean into a higher acceleration or even a lump sum model if it's not LTC filed. That's one of the advantages of 101G is you get to pay more upfront. So that chronic care for Transamerica, for example, has that option. So yeah, just don't say this is the be all end all, but this is a good sweet spot of for most groups you work with for
Yeah,
sure.
actually, because of the recent developments from the last time we were going through this chart, I actually added most popular employer funding because these
Mhm.
are
Yeah,
definitely case by case or, subject to change into the future.
for sure.
Yeah, a couple of notes on the long-term care acceleration. Definitely agree with the higher acceleration amounts. We're seeing 6% for Allstate as very, very popular. They do have a 4% option available, but given there's no cost difference between the two, it's almost like it doesn't exist to us. Just being able to access a higher monthly amount of your long-term care benefit is generally always better if the costs are the same. Transamerica does offer a 6% for facility, but a 3% for home care. So they actually split theirs up between facility and home care. So 6.3 is state and group specific. So it's generally going to have to be a larger group in a state that they have it filed in that's allowable to see something like that. And for Trustmark Life Plus Care, just the last note here, um, 2% acceleration is available for informal care. Now, these plans are indemnity plans, they are generally not cash indemnity plans, allowing you to, no questions asked, no conditions, receive care from a family member or somebody close to you, and you can reimburse them with cash. Generally, there is a component of the indemnity benefit with these carriers that has a requirement that you receive some professional care in order to receive benefits. But Trustmark does allow for 2% of the death benefit to be accessed per month for completely informal care. Now, that's a one or the other proposition. So remember, you won't be able to accelerate the higher amount if you take that informal care benefit.
Hey, Jason, one thing to add, but before we do that, if it's not too much trouble, can you freeze like column B just so, because I know the carriers kind of dropped off.
Oh, yes. How do I do that?
If you, yeah, you can kind of say under the view menu. Uh,
You're exposing my
that's like yeah, the freeze. There you go. And it's the column. Yeah, there you go.
perfect.
Perfect. Okay, cool.
I learned
The one
something
thing,
today.
yeah, the one thing I wanted to add too is one of the other trends that we're seeing, and this is recent since the last time you had this conversation, even, is we're starting to see family caregiving solutions being built into the products.
Yep.
So the one that I've heard about officially released is Trustmark working with CareLoop. That's exciting to see just more benefits available. I think they pay for a certain amount of CareLoop, like the first number of months, X number of months, the service, and then the client has to pay for it, something like that. We've seen Family First is another kind of competitor there that I believe MetLife and Voya have worked with, which are two other carriers not on your list, but they're getting into this space relatively recently. We're hearing about Chubb as well, kind of getting close to announcing maybe a partner there as well. So I think you'll continue to see, right, if there's major competitors that have those solutions in there, there'll be more demand for others to follow. Fast followers tends to be the insurance model. So
Yep.
I do want to mention that because that's a good talking point, especially when you're talking leading the conversation like we do with caregiving and how many family caregivers there are, 50 plus million family caregivers. Having a solution for that built into the product really helps connect the dots,
Yeah, 100%. We
the
get
insurance.
asked about the now quite often when we're talking to groups.
Hmm.
I'm caring for a family member today. Will this help me? Right?
Right.
And so I think the more we're able to address the now
Mhm.
and the future when it comes to extended care and caregiving of any kind, I think that really helps the conversation. It helps how these products are viewed by employees, by employers. Definitely a really good thing. And you hope those who are jumping into it, understand that benefit very well as well, not just, my competitor down the street did it, right?
Yeah. Oh, I should also mention Allstate Standard. Also just recently announced they're working with Family First. I forgot that one, but I just learned that last week as well. So just there's another column that we'll probably have in this chart at
Sure.
some point. Jason, a couple people asked some questions as well.
Okay.
Let me read them out to you. Steve had asked, does Transamerica's UL chronic care benefit have the 6% acceleration option?
It is very state and group dependent. I'll say, Steve, that it can be kind of hard to access because you need a group of a certain size and you need to be in the right state. There's so many little intertwining rules state to state with Transamerica that you really want to just check that out group to group, but there is potential, I will say.
Judy asked a question, and maybe I can take this one, which
Hmm.
is previously some employers offered and then stopped offering group LTC. Was it most likely because the carrier stopped offering the plan, or what was the reason for that? And in my opinion, I'm sure each employer's got a different rationale, right, for doing this. Is mostly it's because the carriers have created some friction for them. So what we see on the group side is billing has not been the most smooth process or servicing in general. And if they get frustrated because month over month they're just having trouble, their HR team is having to spend too much time with administrative processes, we oftentimes see groups stopping just because of bad administration. So it's not necessarily product specific, it's more customer service related. But there are a lot of situations where, they exited the market, and anytime a carrier exits that market, couple of risks. One is that you might lose the offer for new employees. So you literally have to shop the market if you still want to offer to new employees. Sometimes they've done major rate increases with traditional long-term care, and that obviously changes the value proposition quite a bit. So I do think the commitment to the market is very important still, just like it is on the individual market. So you want a carrier that's actively promoting their products in the market. Um, the good thing is we look at the contract to make sure that those guarantees are solid, and the guarantees, in my opinion, have never been stronger than on this hybrid side with the group life chassis creating guaranteed premiums, and for the most part, benefits that are expected to be there. But what I would say is where things might slide if the carriers do experience losses, like underpricing, is the service side of it. So I think it's really important as you're working with your clients to own the servicing as much as you can. That's what we do at Buddy, is we're, an implementation partner, and we think of that not just being an enrollment partner, but also how do we help be an ongoing servicing uh, point. Instead of the client having to go to the carrier directly, we can be an intermediary there and use our technology platforms to make it a better experience. One of those services also is Amada Senior Care, right? We have a great relationship with that national franchise, but they're also an LTC claims concierge. And what that means for us is when our clients have to use their policies go and claim, you have another option to send it to a concierge to help file the claim with the client instead of having to go to the carrier directly, where it may be true that their claims process may not be refined, especially if they're, newer to getting claims on the books, right, for long-term care. So it's just as you think about this, I do think it's important to have a full package for your client. Those will be questions that they ask. Not only is the carrier name something they recognize and their rating, their contract, but also what is the contingency plan, right, for servicing, and you being there to be a part of that is a big part of the value.
100%. Yeah, you got kudos for your explanation, and her next question was, have admin processes improved? So I hope that answered that as well. But any other thoughts?
My overall answer is working with the carrier is always difficult.
Yes.
But each carrier has strengths and weaknesses depending on their specific areas where they have strong people, strong leadership there. Sometimes they have flaws with their operations team. Sometimes there are flaws, with their claims teams or others. So I don't think we can kind of say broad brushstroke, but I can say that we've had struggles with certain carriers in certain areas. And all you can do is, like I said, take control of your destiny as much as possible. But there are certain carriers we prefer just because we don't want, to have a bad customer experience that we can't control.
And developing strong relationships with as many folks as you can at each carrier, and I mean as many as you possibly can,
Mhm.
goes a long way because just like our individual carriers out there, just like really any other insurance carrier out there, there is a ton of division of labor. There are a ton of departments, and there are a ton of people in each department. So the more access you can get to each department, no matter what question you're getting, you at least have a source to go to who will help you track that down, right? And
Mhm.
identify who your strongest carrier advocates are and continue to go in that direction and get introductions from them to even more members of the team over at that carrier.
And
Yeah.
you can tell where the carriers are also making investments and kind of almost predict where the improvements are going to be too. So if the carrier stops investing in those areas, that's a big red flag, right?
Yep.
But these carriers are really aggressively trying to get more into the market. So we're seeing the opposite. We're seeing these carriers investing more than we see sometimes the individual carriers investing.
Yep. Um, so I'll finish up the chart, then we'll go to some of the other questions that we have here. Actively at work, the carrier is generally going to be flexible to what the group needs within reason. But generally, this is what we see on like a cut and dry proposal, a very cookie cutter proposal. Chubb, we generally see 30 hours, but they have definitely gone below that as needed, as requested. Allstate, we generally see it about 20 hours. Trustmark and Transamerica generally have a bit more flexibility. I do see 30 on Trustmark's ULE quite a lot. Um, on their Life Plus Care product, I see a bit more flexibility. Transamerica is easily kind of the most flexible. Are you actively at work able to perform the duties of your job to whatever is considered benefit eligible? I mean, they kind of just cut out the advertise at one level and be flexible as needed to whatever you say is benefit eligible and you're actively at work able to perform the duties of your job, good enough for us. Um, Spousal coverage can really, really vary by carrier. And one of the things we're starting to see a little bit more of is we're starting to see guaranteed issue coverage for spouses, which when we were first getting started, we didn't see a whole heck of a lot of. We generally saw a lot of simplified issue underwriting for spouses, but just going carrier by carrier, Chubb, we don't really ever see guaranteed issue for spouses that much. We'll generally see modified guaranteed issue, which is two really simple screening questions to get through, or simplified issue underwriting, which is about 5+ health questions to be able to answer. Um, MGI is going to be a bit more lenient there. Have you been to the doctor in the last 6 months for anything more than a cold or flu? And do you have HIV or AIDS? Are really kind of like their MGI questions. SI is going to dive a lot deeper into the health, but we generally don't see guaranteed issue for spouses. We will see an MGI and an SI amount that spouses can access. Um, for Allstate, we actually do see a small amount of GI. Depending on group size, this can fluctuate. And it's going to depend on if you have a spouse that is actively at work or not actively at work. Generally, a non-working spouse gets about half the GI amount as a working spouse does in proposals that we see. And spouses also have higher amounts available for SI. Trustmark is, going to depend. We see MGI or SI really for ULE. Life Plus Care is actually a lot more restrictive for spouses, even though it's going to offer what they call guaranteed issue coverage for spouses. Okay, so let me kind of explain that. Spouses for Life Plus Care generally get access to 50% of what the employee purchases up to a maximum of 20,000 face amount, which generally means about 40,000 for long-term care. So it's a very small benefit, and they call it GI, but there is a question about disability. So I don't know why it's not called MGI, but there you have it. That's kind of like the benefit cap for spouses. So when they came out with the Life Plus Care product, I think definitely they had in mind maybe controlling the amount of coverage that spouses can access. For Transamerica, we do see GI for spouses as well, generally sorted out by working or non-working, and spouses generally have the highest SI amounts that we see available to them, maybe right alongside Allstate. So if you're willing to go through health questions, spouses can get a pretty handsome simplified issue amount. Any thoughts there, Mark?
The only thing I would add is these are always in flux.
Yes.
Like today, we learned a little bit that because of just the operations with the standard, Allstate the standard, they are kind of leaning away from doing SI for groups under 250 now for small
Yep.
groups. So and we talked about operations and how the carriers, kind of are different in those different areas. So a lot of this isn't risk related. It's, well, how much time and cost is it for them to set up a small group, to set up SI, to do underwriting on SI? It's more of those considerations we're running into that's seeing those changes. And also just reacting to the market. Who are they competing against? What groups do they have to like win with a proposal. So I don't think it's going to be totally clear where they're going to land on these things. But again, don't take it as the gospel. Make sure, you kind of talk to your carrier rep or, we'll kind of connect you with the carrier rep to get a formal RFP, just so you're presenting it the right way. But I think the GI is the main feature of all of this anyway. So don't get too hung up on that. I would say focus on the GI because that's why most people are going in this direction. And the SI, think of that as the cherry on the top, extra value in the right situations.
Yeah, we're also, communicating the value of these plans many times as a starter plan for long-term care planning, right? So we do have certain cases where groups will take advantage and um, you know, a lot of employees or members will apply into SI underwriting amounts, but we also have many where they'll just do a very small employer-funded plan, and some employees may buy up, but not above the GI amount. So definitely agree with your thoughts there, Mark. Um, and then just kind of typical plan designs we see for small groups and large groups for these carriers. So Chubb, we generally see 150,000 death benefit guaranteed issue for kind of the smaller end. 100 between 100 and 1,000. We'll generally see this 150,000 guaranteed issue. We'll generally see up to 225,000 simplified issue underwriting for employees, and we'll see just an extension of benefit giving you 300,000 total for long-term care and their restoration of death benefit. And their restoration of death benefit, in some cases, actually in many, is going to restore 50% of that death benefit, or I believe in California, this the restoration of death benefit was recently changed in California. Do I have that correct, Mark? Am I thinking of something just completely off the wall?
No, I mean, I think they've made it a little bit simpler so it doesn't have as many moving parts. So you're right in a sense that they just, I think, changed the guaranteed interest rate on the product so that it goes at least to age 100 now
Gotcha.
instead of being reduced before age 100. But again, a lot of those nuances are group or state specific. So again, you'll
Yep.
want to check on it, but it's not something that should be a main, it's not a main reason you would choose or not choose the product.
And I'm just going to change just to be conservative here. For small groups, for all state the standard, we are generally seeing, I would say, actually just keep it at 75,000 death benefit guaranteed issue. And if there is simplified issue underwriting available, we generally see up to 250,000 for employees. We're generally seeing the same thing, extension and restoration built into all plans. All states restoration of benefits is going to restore the death benefit 100%. And if you're under 250 lives, gotta generally be a special case to see simplified issue underwriting in many cases. Trustmark, we're seeing about 125,000 death benefit GI or MGI, and we're seeing about 150,000 death benefit SI with extension and restoration for groups that are 100 plus. Transamerica, we generally see the lowest GI amount and the highest SI amount. Okay, so you're generally seeing about 50,000 GI, but you're seeing 500,000 SI, which kind of blows out of the water, anything we've seen offered from other carriers with that extension of benefits rider. That means 1 million total available for long-term care. Um, Once you get over 25, you could start to see 100,000 for groups, but it's really going to be case dependent.
Yeah. And I'll get on a little bit of a soapbox here and say that the GI amount, while it's something that we spend a lot of time talking about, negotiating, it probably doesn't move the needle as much as just the value proposition and the pricing. Like so 500,000 sounds great, and we love having that option for the right types of clients, but the likelihood that they max out that amount of coverage is low because of the cost of the plan at that much coverage, right?
Right.
So it's all a function of that pricing. The all state standard, one of the reasons we love them in California and Utah is they have 5% compound inflation. So it's not really 75,000, it's 75,000 growing at 5% compounded every
Right.
year. So you just have to make sure you have that context and that pricing for that rider, that 5% is very inexpensive. That's why it just pops. You
And I
know, so
think,
you just run the quote and look at the quick quotes, like for example in the buddy system portal, and that will help, I think, guide you more than just looking at just the limits and making a decision based on that. I don't think that's the most important thing to you or the client, and participation doesn't depend on that as much.
yeah, and I think just to be able to add a little bit to that, if you're communicating and marketing and educating only on the guaranteed issue max, you may be hindering participation a bit because, especially for voluntary enrollments, there are folks who don't have the disposable income or the room in their budget to afford a monthly or biweekly premium all the way up to the guaranteed issue max. You have to at least give some play to the idea that even a small amount of benefit is going to get you a really valuable couple hours of care. And the ability to show that much more agreeable premium level alongside what you have the potential to purchase up to the maximum. It's a super important piece to this. No other carriers that are offering the inflation rider right now that I see, Steve. And um, Allstate technically offers an inflation in other states, but it is not actually what we would consider in the long-term care specialist world inflation. It increases the amount you can accelerate, but it does not actually increase the long-term care amount. That's why we're generally focused on California and Utah, because that increases your total long-term care benefit along with the amount you can accelerate.
Hey, Jason, let me also answer Chris's question. He had asked
Yeah,
us
okay.
earlier on
hmm
if a company uses a PEO, how do they set up a group LTC plan? And this kind of gets into your large group a little bit, which is the carriers really want a W-2 employer-employee relationship. That's the preferred types of groups. So that's your employers that you're well aware of, but also at PEO is a co-employer, and so those might be a lot of small businesses that get their benefits through a larger organization, but they do have that W-2 relationship. So most of these carriers do like the PEO market. Similarly, if you work with unions and other entities like benefit cooperatives that provide benefits commonly to those employees, those can be really good cases. We've had really good outcomes, just like with employers. The only ones that are challenging are those non-employer groups where there isn't enough of a benefit culture, offering marketing, where the filing process may be more difficult for associations. Those can be more challenging. Now we tend to specialize in that, and we work with those groups and really help them almost become their HR team in a way, and getting that out to their members. But in terms of which carriers want those companies, I would say think about the ones, what other benefits do they offer, and does this fit? Like if they already offer life and disability and have success with that, I think the carriers will give you an offer for the long-term care too.
Perfect. So
And
really quick for large
yeah,
groups, there are just over a certain size segment, you may see enhanced offers from these carriers. One of the things that we generally see from Chubb, the guaranteed issue amounts don't generally rise, the simplified issue amounts don't generally rise, but what they will do is they will offer something called EOB2, which is beyond just a doubling of your initial long-term care benefit, they will triple the initial long-term care benefit. So let's just do round numbers. If you buy 100,000 a death benefit, you actually get 300,000 total for long-term care over 75 months at 4,000 a month, as opposed to 200,000 for long-term care over 50 months at 4,000 a month. So that's something we generally see for larger groups. Very nice, um, kind of value boost there for sure. At Allstate, this is about the upper limits we see. 200K GI may be for the largest of the groups out there. A lot of groups will maybe see like 150,000 GI. SI amounts generally stay the same, and you may see higher GI amounts for spouses, like 40,000 for a working spouse, 20,000 for a non-working spouse. Trustmark for ULE will generally give us 200,000 GI, 250K, MGI, the two health questions, 300K, simplified issue with extension and restoration. Their Life Plus Care product, I have not seen really any variation from large group to small group. It is a very kind of straight up product, and I think a lot of the reasons they did that with the design was to make it easier to enroll on modern enrollment platforms. I think that's kind of one of the angles they took there. But as we kind of continue to see more Life Plus Care groups and there is variance that pops up, of course, we'll make sure to update. And then Transamerica for all groups 1,000 plus, we're generally seeing about 150,000 GI, 500,000 SI. We don't really see spouse amounts change all too much, but EOB and ROB there.
Yeah. And
So
I'll
that's
give
my chart.
also a special shout out to Allstate, Standard, and Transamerica because they give you 100% restoration.
Yes.
And I do think it makes a big difference because the mentality is if I don't use the long-term care, I'm getting the death benefit. But if I use it, I'm also getting that same death benefit. The conversation is simpler, and all of a sudden it opens up a lot of creative thinking about employer funding and are we getting value out of this plan? And the fact that you always get the death benefit, kind of helps that story quite a bit. So again, it's just, you have to look at the pricing and how it compares, but we're finding those products to be also price competitive. So it's not like you're paying a whole lot more because you're getting 100% versus, getting a lower amount. So I would say that that's something we're leaning into a bit more just because of the positive responses we're getting there. And,
Yeah.
and officially, just for everyone to know, because it will get confusing a little bit, the standard is now on the all-state proposals. So it is kind of becoming much more official that they're going to be branded the standard. And I think as we're going through the study group and what you'll see in the portal, you'll start to see us using the standard more. Because 2026, they're supposed to get off of the all-state brand officially. So don't be confused. It's all the same company, same product, same people. Everything's the same. Just in terms of the parent company is going to be the standard.
Yep. Um, we had one more question from Chris. Can the company buy it separate from ADP? I think that may be related to the PEO question.
Yeah, so we're starting to see a lot of crossover where you might have the ability to do it through a PEO and the ability to get your own small group plan. And I don't think the carriers are checking at the employee level what they're being offered already. So yes, absolutely, they can get their own standalone offering, but obviously they can't double dip. They can't buy it twice or that type of thing. So I don't think that should be a limiting factor. We do run into sometimes you have the parent company and they have to go to the parent company for approval. So be aware that that could happen. If you're doing like a standalone offering, you might have to get approval for it, that type of thing. So just be aware of that. But otherwise, I would say, go for it and get them their best offer. And again, people that are enrolling and participating is the name of the game here. So that's really what the carriers care about the most.
Perfect. Anybody else have any other questions on the info we went over? Just wanted to kind of give you, again, a bit of a well-rounded sort of summation of the top carriers that we have out there in the market right now and help you find those sweet spots. We have tools that will assist you, but it's really good to just kind of know this information and have it to reference off the top.
Actually, I have something to add, but Leland had asked, and I had this question too, so I'm going to put you on the spot. Is there a way to get that Google Sheet? Or are you going to put it in the portal? What are your thoughts on that?
We're still figuring out what, well, I say we, it's really just me. Yeah, I mean, you can have access to it for sure. I'll put it hmm. I need to decide where to put it, Leland, and then yes, I'll make that decision before I put the recording out um so that you can take a look.
And his follow-up question was, is there a sheet like that for individual LTC? There used to be. I wonder if we still have
There
it.
used to be. It is very, very old. When we made our transition over into the group market, it kind of got a little left behind. But it is something we can kind of get back up to speed and do a study group on so we can really review all the products there. I mean, there's a heck of a lot of products. That's why I try to do them study hall by product type nowadays, so that we can kind of keep them segmented. I would say never say never to its revival.
Or another way of putting it is, your feedback is important to us. And actually, in this case, if other people really want that, I think I won't want access to that too. We'll make it happen. So we'll let you guys know what that might look like. But that's a great suggestion. Um, the other piece I wanted to mention real quick, Jason, before we jump off is, we talked about the top four carriers, and I want to point out why. There's probably now about at least a dozen products in the marketplace. Many of them are chronic care, but like we've talked about, the definitions are very similar. Um, Many of them are LTC filed or something in between. The thing that differentiates them for us has been the extension rider. Just like on the individual market where you can accelerate and all you can get is up to the face amount or less, or the other products with the extension rider would give you far more LTC well beyond the life insurance. That's the same kind of decision that we're looking at in terms of the group market. And it's really a positioning with clients too. We want to be able to say these products are LTC first and life insurance is secondary, but it provides really valuable guarantees, which makes the message a lot easier because if you go into a group and you say, I'm going to offer you term life, they're going to say, well, I already have term life, or I don't need more life insurance, even if it's permanent life. And that is the wrong conversation to be having. But that is probably the number one objection we run into is why am I adding this? So it's really important early on to stake a claim to say this is LTC with life insurance and not the other way around. And that's been really well received. So I would definitely make that a point. But I do want to give a shout out to a couple of carriers. Voya has entered the market relatively recently, does have an extension rider. We're still trying to determine where are the sweet spots versus the other top carriers out there, but they're big in the voluntary benefit space. Equitable, another carrier that has a product like Chubb's product, but they're also working on developing their own long-term care product too. So I'd expect to hear more from them. MetLife, which doesn't have the extension rider, but will accelerate a higher percentage. So again, may have a sweet spot there. I don't know if they've released their product in New York, but again, potentially another New York carrier where we have fewer options. Unum has chronic care rider. Some of the other big ones, I think Aflac as well, and some of those other companies too that are in that voluntary benefit space. I heard Mass Mutual will be launching LTC riders. I don't know what it looks like yet, but they have chronic care already. So I want to point out all those carriers to let you know that, definitely reach out to whichever carriers you want to learn more about or you might already have a relationship with. Find out, do they have LTC on their product? You might be surprised to find out that, again, if you just have to file a rider on a product that you've already filed and it's been approved, a lot of carriers can get to market very quickly with these products. So just great to see like all of the different competition that's happening there. And if you guys find a carrier that you're finding has a special sweet spot that you like, let us know. We want to be aware of it too, and we want to be able to share it with everybody in the study group.
Yep, 100%. And make sure to read those contracts if you do stumble upon a new solution, because just because somebody is a wholesaler or sales support for a given carrier does not mean they are a long-term care specialist. The product may be taught to them in their trainings a certain way, but the contract represents the product at the end of the day, most of all. So I would say if you find a new solution and they're like, yes, we have long-term care on XYZ chassis, just ask for a specimen contract. And you don't necessarily have to read it all. You can plug it into AI and start asking it questions. You can send it to us and we will both read it and plug it into AI and ask it questions. So just make sure because the way the contract is worded can have massive implications on the way the policy actually works for the folks who purchase it when they need it. So just a word to the wise that we're broken records about, but just wanted to leave you with that message. Anybody else have anything that they want to ask or share with the 2 minutes we have left? Otherwise, we will wrap it and get you out of here a minute or two early. Appreciate the time, everybody. We will talk to you next week. Be well until then, and let us know if you need anything. Have a good one.